Hi, Michael. Can you hear us?
Yes, I can hear now. Can you hear me?
Yes, we can. You cannot see us, but we can see you clearly.
Okay, good.
Okay, great.
Great. Thanks for joining us today. Really excited to get into this fireside chat. So today we're going to be talking about crvUSD, its design, how you think about peg stability, and interest rates, and specifically getting into a little bit of central bank approach comparison to how you guys have thought about this. So I'm really excited to get into these questions. I guess to kick us off, can you give us a brief introduction of yourself, Michael, and also crvUSD? And specifically, I'd love to hear what you think is unique about its design.
Mm-hmm. Yeah, okay, so it's already a broad question. So about myself, I founded Curve Finance in 2020. Originally, it was a stablecoin exchange, and by education, I'm actually a physicist, so applying the physics approaches in whatever I'm building. So, and specifically coming to crvUSD. I think the main reason why I actually decided to do it was that I wasn't very happy about liquidation mechanisms which exist in today's stable coins or like CDPs or in lending platforms. Because like when if let's say price of collateral goes down to some critical price, you actually get your position fully liquidated or partially liquidated, and there is no kind of way to come back from that, and that's not algorithm how to make essentially reversible liquidations where you actually don't really have to be scared all that much about liquidations when you are close to a threshold. But that's kind of only one thing about crvUSD. There is another thing is how it stabilizes, and it actively uses well, something we call peg keeper, which is maybe can be compared with PSM, but more efficient, and dynamic interest rate model, which appears to be working actually much better than I anticipated, especially when combined with peg keeper. So it's yeah, basically appears to be a combination of like CDP with this what we call soft liquidation mechanism, which also deliquidates you if price of collateral goes back up, and the dynamic interest rate model with stabilization mechanisms, which appear to give very, very, very good stability to the stablecoin.
So yeah, I think maybe to tie that together, so you're really focused on improving liquidation mechanisms to be able to have better stability of crvUSD compared to other stablecoins.
Yeah, well, I would say it's two different things. Liquidation is works on not necessarily to improve stability, but more to give more comfort to borrowers. And but it actually ties into stability mechanism pretty interestingly.
So maybe let's dive into that stability mechanism a little bit more. Can you explain how you approach peg stability more broadly? I mean, maybe a good way to do that would be to compare to a mechanism in another protocol such as Maker.
Right. So one is our peg keeper module, which is essentially if it happens so that demand for stablecoin is very high and market tries to buy it so the price of stablecoin tries to go above 1, then the peg keeper actually mints stablecoin, or well, it's pre-minted, but let's say it mints stablecoin and deposits single-sided in the pool with this between this stablecoin and some redeemable stablecoin or several of them. When it does that, the price of crvUSD goes down, so it's like a little bit like an exchange, really, and the peg keeper keeps liquidity in that pool temporarily. But let's say if the price of Curve stablecoin went down and it's below 1, then peg keeper takes its liquidity and withdraws crvUSD and let's say burns it, right? When it does that, when you withdraw crvUSD single-sided, the price of crvUSD goes up because it's a little bit like buying crvUSD. And so it means that if price of crvUSD is too high, it tries to push it down. If it's too low, it tries to push it up. But the problem is also that if peg keeper doesn't have any reserves, let's say it's empty, then nothing can hold crvUSD on the downside except for demand to repay the loans. But not everyone wants to repay the loans because maybe people have reasons to keep their loans up. So then to help in this case, we have a dynamic interest rate. So if price of crvUSD goes really down, then interest rate goes up, and people really want to repay their loans or really don't want to borrow, at least before the price of stablecoin goes back up. But instead of just making this interest rate only depending on the price of stablecoin, we also made it dependent on the reserves of peg keeper. So if peg keeper has lots of reserves, those reserves partially back crvUSD, obviously. But if peg keeper has lots of reserves, then we actually want to encourage people to borrow more, to have less reserves in peg keeper. Because when people borrow, they actually borrow crvUSD and sell it for, I don't know, for redeemable stable coins, or sell it for crypto when they leverage. So if you make interest rate low, people are incentivized to borrow more and sell, and then the price, the price pressure is down. So we want down price pressure if peg keepers have too many reserves. But if reserves of peg keepers are low, then the borrow rate is high, and like people want to buy crvUSD to repay their loans, or maybe don't want to borrow, so the price pressure is up, and when the price pressure is up, it also feels the peg keepers. So we have this negative feedback mechanism, which is organized by both this peg keeper module, which is providing a fast feedback, and a dynamic rate part, which is providing a slower feedback. And combination of these two feedback mechanisms actually stabilizes the stablecoin really, really well.
Okay, so it sounds like the main difference there is that you're adding another element to how you determine the price, which is the reserves of the peg keeper. Is that right?
Yeah, it's not like determining the price, it's determining the borrow rate.
Okay.
So it feeds into dynamic borrow rate, and it's not governance which changes what the borrow rate is. It's really the algorithm, and somehow it happens that volatility, which would have been otherwise in the stable coin, comes into volatility of borrow rate. So borrow rate can go up and down, and it does. On average, it's about 5%, but sometimes it goes to 10%. Some good times it goes to below 1%. And maybe it's not great for some borrowers, but it's actually better this way than if this volatility comes to price of the stablecoin. So you need to push the volatility somewhere, and when you push the volatility to borrow rate, it appears to stabilize stablecoin.
So you mentioned something that I think is pretty important there, that this is automated. It's done with algorithms and not by any vote of the DAO. And I think this is an important difference to how stablecoins, and particularly crvUSD, approach peg stability compared to traditional currencies like ones backed by central banks. I mean, so central banks, they're not quite as automated. And I'd love to hear from your perspective if you think it's possible to create a robust and stable currency with this full automation that we see, like fully reliant on, you know, automated market makers here, or if we'll see more nuanced mechanisms come up that allow for more integration with like existing financial systems.
Yeah, I think it's not even like just automation. It's actually also how exactly central banking currencies are created and what the key rate over there does compared to borrow rate. And the important difference is that the rate which central banks sets, it's actually not the borrow rate necessarily. It's the rate which central banks pay to, let's say, to commercial banks when they deposit their reserves into central bank. So essentially, central bank prints money if you deposit money in there, right? So let's say if the price of I don't know, US dollar, right? So the buying power of US dollar goes down, right? Tries to go down, and let's say you don't want that. You start increase the key rate and start printing money for banks to remove the liquidity from the market and push the price of buying power of USD up by doing this. And well, this helps temporarily, but you might end up in Terra kind of situation. And to not have that, you have the whole like manual control of how central bank works, to have this rate not very high, to kind of compare it to economic growth. And when you measure how quickly economy grows, you don't want to fool yourself. And otherwise, things can go ugly. And in some countries, they do. So anyway, it's in CDP model, not just for crvUSD, but I guess for anything, it's upside down. It's you set the borrow rate. So if you want you don't print money for those who deposit. You actually have people borrowing funds, and you by changing the rate, you control returning the loans essentially, right? Or control not borrowing more. So, and that's a better mechanism because it's actually more sustainable. There is no Ponzi component in it. Like, it cannot become Ponzi. That's the most important thing. And that's why it can be automated, because like if you automate something and let's say it's fully autonomous, but let's say if it can become a Ponzi, then it's not good. So you don't want to create such a system. But if it's so you don't want positive feedback loops, you want negative feedback loops, which stabilize things. But that's just one part. Another part, which I didn't really think of much at first, is when you mix it with soft liquidation mechanism for curve stablecoin. And maybe I need to explain how this soft liquidation works. Yeah, because normally in typical CDP, you have a loan or backed by, let's say, cryptocurrency. So you have some value of cryptocurrency and you have some value of your loan. And as long as value of cryptocurrency is higher than your loan, then you are good, right? So and let's say if value of cryptocurrency drops critically low, you have liquidation. So what happens here? If value of your collateral, which is cryptocurrency, Ether or Bitcoin, becomes critically low, it actually starts converting this cryptocurrency to stablecoin, this crvUSD stablecoin via an AMM. And if the price of collateral goes really too low, then you have all this collateral fully converted to crvUSD, and you basically have, let's say, $100 crvUSD loan backed by 110 crvUSD, right? So you can actually you already sold your collateral at this time when if it dropped for crvUSD and actually bought more crvUSD than your loan is, so it's fully covered. But if you have price of collateral going back up, then this special AMM it starts buying back collateral, and if the price of collateral went fully up above liquidation price, then you appear like fully converted back to your collateral. So if price of collateral dropped and then went up again, then you have your collateral back, maybe with some loss, but this loss is usually like nothing in comparison with losses you have in like traditional liquidation. So this mechanism is pretty good for borrowers because, let's say, if a price of your collateral went fully down, you actually have it like stop loss being executed, and you have your position is in stable coin, and it's fully covers the loan. You can pay off the loan and take the difference because you've been over collateralized. But let's say if price of collateral went back up, then you have back your collateral and you can still loan it, and that's so that's good. You can sleep well and not being worried about being liquidated while you sleep. But the good thing, the most interesting thing is that when you convert your collateral to stablecoin, let's say your collateral goes down, it's a bear market, and it gets sold for stablecoin, right? When that happens, stablecoin gets bought, so its price tries to go up. Peg keepers try to mint Curve stablecoin and deposit it to stablecoin pools to push the price back down to 1. And when they do that, the interest rate, the borrow rate decreases. So if it's a bear market, if let's say crypto economy is going down, everything is bad, then borrow rates go down, and this encourages people to borrow more. That's, if you think about it, you could apply it even to traditional economy. Imagine such a system working in traditional economy and having loans backed by I don't know, companies, right? So if economy goes down, then interest rates go down, and that's, I guess, not something you typically see. So you kind of probably would support the economy by that. So that's kind of an interesting thought I had. But anyway, this is, for now, we observe that just in crypto. And yeah, indeed, when crypto went down a little bit, then our borrow rates went down, and this encouraged more loans, and that was interesting.
Yeah, this is actually how central banks are designed. Definitely, like interest rates are there as a mechanism to be able to either ignite the economy or try to calm it down. And so when you
but the problem is that usually in central banking, the manipulation with the rates,
it's very indirect. You're right.
Yeah, they try to stabilize the currency, and in their case, seemingly the goals of stabilizing the currency are a little bit in a conflict with the goal of supporting the economy, and here these goals are kind of seemingly aligned. So that's a kind of interesting observation.
Yeah, another super important thing here that I think is really interesting for the future is that you're basically able to borrow directly from a central bank in this case. You know, as a borrower, you can go directly into, you know, crvUSD, and it's almost like you would be able to borrow directly from a central bank as a person. And I think this, shortening of that.
But you still need to think about collateral, like with what do you collateralize your loan? So, and you probably want some prime collateral, which is not. Then it would mean that it's not a person who borrows from central bank. It would still be large companies. So it's still a kind of. Otherwise, it's just not as safe. Not safe to back the currency by this collateral, right?
Yeah.
So that's. But
you are shortening
it sparks some ideas.
That space in between the individual and being able to interact directly with that mechanism, which I think is, for me, super interesting about these. But another thing that I wanted to touch on with you is you mentioned, these stable coins being over-collateralized. And I'm really curious to hear from your perspective if you think that it's possible to sustain these stable coins into the long run being heavily over-collateralized in this way, just because being over-collateralized means that it's more expensive to maintain these.
Well, I mean, you over-collateralize them by volatile currencies. And, if you have this soft liquidation mechanism, it appears that you can afford quite high LTVs. So the highest you can do is, in our case, is 89% with Ethereum or Bitcoin collateral. And this LTV doesn't mean that you let's say if you borrow maximum and price of your collateral goes down by 1%, you don't get liquidated instantly. You have this soft liquidation thing, which means that you actually can get close to maximum utilization of maximum size of the loan. So you don't really have to leave that huge of a margin over there. And I probably wouldn't really go borrow 89%, but some people actually do it. I kind of found for myself like a good region where you can make the safest possible loan. You can actually change some parameters when you borrow, and then with 71%, it's you can actually be pretty safe, like in any place, whether in soft liquidation or above. So you actually, so it means that you don't really have to be 200% or 300% over collateralized. I think being at, I don't know, somewhere about 130 is okay. And so you do increase capital efficiency this way.
I very sadly think we're at time. I kind of want to round this conversation out with you before we move on to this next panel and just ask you how you see crvUSD developing from here and what you think is going to be most important for it to continue to strengthen.
Right. So I guess the most important part for crvUSD is to get adopted as a stablecoin, because borrowing is good, but you cannot borrow more than it is used in reality, and so this adoption as a stablecoin is very, very important apparently. And another thing is, of course, good to support multiple collaterals, including liquidity tokens, and maybe it's good to have lending markets which use the same sort of soft liquidation algorithm. That kind of stuff is probably good to explore. And because like we only tried this mechanism with prime collateral, like what happens if you have more volatile stable coins, not necessarily backing, more volatile collaterals, not necessarily backing stable coin. So this is probably something we would look at next.
Okay, look forward to seeing that those efforts to increase crvUSD adoption. Thanks so much for joining us, Michael, and explaining it a little bit more to us. And thanks for listening.